A couple of days ago, I was talking with a friend about investing, and I realized that I had this topic in my list of videos for 2024. And I think that this is a topic that may be of interest for many people, especially because January is the time when you start setting your goals, and one of them may be investing. So first of all, I'm not a financial advisor. I would say what I know about investing because I started my own investing journey in 2021. What I want you to do is in 2024 to move away from the reflection mode and go to the action mode. And in order to do that, I will recommend you 5 key steps. The first step is to look at your goals. So write down your goals. Why do you want to invest in the first place? What do you want to get out of your investment? How much money are you able to invest consistently? The second step is to open that investing account, because if you don't open one, you won't be able to start. The third step is to put money in that investing account. The first amount of money you put in may not necessarily be the same amount every month, but you have to start with something, so you need to put some amounts in the first place. And the fourth step is to actually buy assets in that investing account using the money that you loaded for the first time. And the last step is to be consistent with step 3 and step 4. Before I go too much further in the topic, let me introduce myself. My name is Ange, and I do videos about looks, lifestyle, and abundance mindset. And this video is part of the Abundance Mindset series. I may do more videos on this topic in the weeks to come. So let's take our 5-step approach and start with step 1. So in step 1, I want you to grab a pen and a piece of paper and write down why. Why do you want to invest in the first place? And let me tell you that investing is not the quick way to get rich. So unfortunately, this is not a get rich quick scheme. It does take time to invest, and you need to be aware that investing is actually a long-term process. It does take time to build wealth, so the sooner you start, the better for you at the end. But if you think that you start too late, don't worry. It's better to start than to never start at all. So when it comes to what you want to get out of your investment, think of what do you see when it comes to investing money. Do you want to actually use your investment as part of having a supplement source of income? And if it is the case, again, I will tell you that if you're a true beginner, you may see that the money that you're going to get out of your investment, if you decide to buy stock that gives dividends, the dividend may be quite low at the beginning, but the more you invest, and then the more the dividends payout will be a bit bigger. But it can be the case that your investment becomes another source of income, but don't expect thousands of euros, especially in the first few years of your investing journey. If you have an approach in the longevity, you are looking at investing as part of a retirement plan, know that you can do that through your company with a pension fund. But if you don't have that, you can also leverage your investment as part of an additional income when you are going to retire. So this is why it is important to think of investment in the long term, and the horizon should be around 15 to 20 years, and even better 30 years if you are looking at implementing your retirement income. Let's say that you have public pension, and we all know that public pension is not that good, especially nowadays. So having that money invested will be as well a good plus for you. And as well, when it comes to knowing what you want to get out of your investment, it's also looking at what type of assets you are going to invest in. So as I said, somebody who's looking at having an additional source of income from their investment will probably focus on an approach where they are going to buy individual stocks and hope to receive dividends from them. And somebody who is more focused on the long term, on the retirement aspect of it, may not necessarily be interested in dividend stocks and may look at accumulative ETFs, for example. So I know that these terms may sound very complicated, especially if you're a beginner in this journey, but I will go through those terms in the next few minutes. We also need to think of how much money are we able to put toward our investment. And this is very important because you don't want to start putting, let's say, I have 1,000 euros saved. I'm going to put 1,000 euro in my investing account. I'm going to invest in that one stock and I will hope for the best. So this is not the approach you should take, especially if you are a new starter. You need to think of, obviously, how much money you can put for the first time and then how much money you can put consistently. Investing is all about the consistency and it has to be done regularly. Some people would invest every week, every 2 weeks. I personally invest every month because I am an employee and I receive my salary every month. So when I receive my salary, I just allocate a specific amount towards my investment, and automation is key. So I don't have to worry when to transfer the money to my investing account, because I have set up a specific date for my money to be automatically transferred toward my investing account. So that's that about thinking of your goal and thinking about the money that you can put towards your investment. The second step is to open that investing account. When you get to the second step, you start realizing that you are moving away from the thinking phase and you are actually taking real action. So it may sound a bit difficult, or you may hesitate on which platform or which brokers. This is the same thing. A broker provides a platform where you can invest your money in. So you may be a bit hesitant on which one to pick. I would advise to not spend weeks and months trying to figure it out, because most brokers and investing platforms offer similar assets. But I would advise you to go to websites such as Broker Chooser, where you can actually compare different brokers and platforms, see their different conditions, and see what is suitable for you. For example, when you go to their website, they ask you, where do you live? So usually you put your country, and you will see a list of the top brokers available in your country. You can also add which asset you think of investing in, and as a true beginner, I would only focus on stocks and ETFs. When you scroll down and hit compare brokers, you will have a comparative table with the different brokers available in your country, and then you can look at the different criteria to make an informed decision. So to me, there is a few things to consider when you choose your broker. The first one is to look at their fees, because obviously there would be maintenance fees and there would be fees for each transaction that you make. The second one is to look at, is there any minimal entry deposits in order to start with their platform? So some brokers or investing platform require a minimum deposit. If I take, for example, eToro, which is one that you may already know because it's advertised everywhere. I have an eToro account, and I also have an Interactive Broker account. With eToro, I remember that I had to put 200 euros as a minimum to get started, and then you can put any amount you wish. And with Interactive Brokers, I did not have any minimum amounts in order to get started. You may see this criteria as important, especially if you don't have much money to start with. But I want to reassure you that anybody can get started with any amount of money, but just make sure that you look at those entry conditions. The third criteria that I would look at for picking my broker investing platform is to look at the inactivity fee. And usually it means that if you open your account and never go back, then after a certain amount of time, they will charge you some fees out of the balance that you have in your investing account. Usually it's just a matter of logging in and logging out to make sure that you do it at least once a year. As I said, investing is a consistent approach, so you won't be doing that only once a year, so you don't need to worry about any inactivity fee. The most important thing, although it is the last in my list, is to look at safety. So in terms of brokers and investing platform, you have to see how they are regulated, which is very important because you want to have some safety in place. So regulators such as the Central Bank of Ireland or any regulators in the UK or in the US seems pretty solid to me. You also need to look at your investor protection, what are the terms and conditions, and how are you protected in case that this provider goes bankrupt? How much money are they able to give you back? So this is something that you really need to consider, because obviously investing is still a risk, although it is proven that it is the only way to beat inflation, and it is better to invest your money than just doing nothing, because if you keep your money in the bank only in savings account, the return is actually very low compared to the return in the stock market, which is about 7 to 10% every year. I also know that in some countries you can invest through your bank, your actual bank where you have your debit or credit card. Personally, I did not go through that route because usually banks have higher fees, and as well I prefer to manage my own finances and take control of my money. So my personal advice would be that you are better placed to know your requirement when it comes to your own finances and when it comes to investing. And what I really love about investing, although I've been doing that for only 3 years, I really love the journey and learning more and more as I go through this journey. by myself. Now let's move to step 3, which is actually putting money in that investing account. Once you have that investing account opened, you need to put money into that investing account. Don't worry if you can only put, for example, 100 euros or 300 euros. Some people may have more savings and they may be able to put 1,000 euros, which is very good. You need to think of the minimum deposit that you need to put in, depending on which platform you pick. If there is no deposit, it is very good because you can put any amount you wish. Obviously, somebody who starts with a bigger amount will be a bit further than you, but don't worry if you only have, let's say, 100 euros you can put in the first place into your investing account, because most platforms nowadays allow people to buy fractional shares, meaning that if you look at one individual share of a company, and you realize that in order to buy just one share, you have to have 900 euros. It is unlikely that a beginner will be able to allocate 900 euros to invest in one single stock. So fractional shares are actually the best way to get started. And this is why investing became so approachable for anybody, because if you buy a fractional share, I think the minimum is only 50 euros that you can put towards fractional shares in most platforms. So you can actually build buying one stock by buying multiple fractional share of that individual stock. So that's why the amount that you start with doesn't really matter, although it is better to be able to buy one unit of a share. But be careful, because some investing platforms don't allow you to buy fractional share. And this is the case, for example, of the Giro or the Giro, I don't know how you pronounce that, broker. Unfortunately, I think as of today, as far as I know, you have to be able to buy the whole share in order to make your investment. So maybe this is not the best option if you don't have too much money at the very beginning. So as I said, put the money that you can, look at the entry requirement, but if there is no minimal amount, just put the best you can. And then as you continue to invest and maybe your own income will increase, you can then put more money towards your investment every month. So it is very important to understand that investing is not about taking all your savings and putting them into your investing account. I will recommend you to still have savings, but also focus on investing. So it is important to still have cash in case you have something that you need to pay, an emergency. So make sure that your savings are for any emergencies or any specific goal. If you are looking at buying a house, then you may focus on saving more and investing as well, but you still need some sort of cash available in your bank account. So don't put all your saving into your investing account. This is a big mistake, in my opinion. Just allocate 1% of your salary out for investing and another percentage for savings. And when it comes to the investing part, make sure that this is something that you can sustain as well. So for example, I started investing with only 400 euros the first year. And then every month I was adding maybe 150 euros every month, but this was done every month, so it was consistent. And what I would recommend you is to automate everything when it comes to putting your money out of your bank account to your investing account, so you don't need to think about it. And then don't think that because you have put money in the investing account that it's all you done with investing. You actually have to buy assets. The worst thing you can do is thinking that because you put money consistently towards your investing account that you are actually investing. Don't make that mistake. Please, once the money is in the investing account, make sure that you actually buy the assets. So there's different assets that you can buy. Most of you may know stock and shares, which are basically the same thing. It's one share of a company. And if you don't have the total amount to buy one single share, just buy a fraction of that share with the amount that you can. For example, let's take a random company. I love LVMH because I love luxury. So let's take LVMH, and I know that sometimes their share price is between 700 to 900 euros. And it is unlikely that when you start, you have 900 euros to put toward that one single share. And what I also recommend is that the money that you put in initially should not go toward only one company. Just try to diversify. I'm not going to tell you which company to pick or how to pick a stock because I'm not a financial advisor. There's different indicators that you can look at, but usually the beginners, I would recommend you to look at index funds and ETFs instead, because if you start with index fund and ETF, it is also a way for you to diversify your portfolio, because an ETF is basically a combination of multiple shares from multiple companies. So you have shares from, for example, Microsoft, Apple, from pharmaceutical companies and other industries. And usually an index fund or ETF follows a specific index. So the most popular one is the S&P 500, which are basically the 500 leading company in the US. This index fund seems to be, I suppose, popular amongst investors, and it has a good return. So there are different other indexes as well based on different companies and different countries. So for example, in France, we have the CAC 40. In the UK, there is the FTSE 100. I think that as a beginner, it is probably the best option for you because it will remove the headache of knowing how to pick a stock. And when you invest in an ETF, you are actually investing in multiple companies at the same time. So as I said, this is the process from 1 to 4, knowing your goals, opening that investing account, putting the money in and buying the asset. Most likely it will be for you an ETF or index fund. And when you buy that asset, don't think that it's you done. You have to do it consistently, and you can also buy different assets. For example, 1 month you put your money towards an ETF, and maybe on the second month you decide to open another ETF. But the only thing to be aware of is that with all your investment there is a risk, but you also have to pay tax. So I would also recommend you to be aware of the tax regulation in your country when it comes to investing, because although you are investing in that platform, you still need to declare the dividends that you receive if you decide to invest in dividend stock. If you decide to, for example, invest in distributing ETF, which also works like stock and give you dividend. So I'm not going to go into the detail of tax and how it works because it's very different depending on where you live. I live in Ireland, and for example, income tax on dividends is 41%. And I think that capital gain tax from the stock that you may sell and get profit from are about 33%. So based on your country, those numbers will be different. And you also have to know rules about ETFs. There are different ETFs. So as I said, the distributing ETF will distribute dividends, and the accumulating ETF will not distribute dividend, but they will reinvest them into the ETF. In that occasion, then you don't necessarily declare any dividends, so you don't pay income tax on the accumulating ETFs. But there are some rules depending on the countries you live in. For example, in Ireland, after a certain number of years, they consider that you have cash out the money from your ETF, and then you have to pay a certain percentage out of the value of your ETF. This is going to become complicated, so I'm not going to go through that. I'm happy to do another video in more details on the different assets available when it comes to investing. But for the sake of this video, I'm going to make it very simple and talk about step 5, which is consistency. As I said at the very beginning, consistency is very key. You need to have a long-term horizon, and as I said, personally, I see myself investing for many years, 20, 30 years. While starting with investing, don't focus too much on how much dividend you will get out of your investment, because it is unlikely that you're going to receive thousands and hundreds of euros. It will start with cents if you only invest in fractional shares, and then it will go up over time. One last thing as well is that it is a journey, it is a marathon and not a race. Don't compare your situation to other people who may have more money to invest in than yourself. The key is to be consistent with your approach. Invest every month at least, especially if you are working a 9-to-5 job, and don't worry about how much you can put in the first place. Let's say that in the next year you are promoted and you have a new job which gives you a better salary, then you can increase the amount of investment that you do every month toward your assets. And finally, investing is a risk, but it has been proven that it is the only way to beat inflation, because if you keep your money in the bank savings account, although it is very good because it has to be saved for a specific goal, but other than that, savings account only give you 3 to 5% returns at best, whereas investing in the stock market give you on average a 7 to 10 return every year. My last word to you would be to take a step-by-step approach. Stop reading too many books, get started today, and as you go through every step, Obviously, you can still take a break to take a look and inform and educate yourself. There are so many websites out there. One website that I will recommend you is to look at Investopedia, which is basically a dictionary or Wikipedia for finances and investing. And this website is very good because it has all the definition you need. My recommendation is to actually don't read all the books, but read the information you need. For example, when you start opening your investing account, or you look at opening your investing account, if you come across a term you don't know, just go to Investopedia, type the name, and they will give you the definition. So I really like this website because it is very informative. And as I said, with investing, it's a journey. You won't know everything, but you have to get started in some ways. That's the end of the video, guys. I hope you find it informative and useful. I wish you all the best in your investing journey, and I hope to do other videos about this topic. And in the meantime, as always, stay blessed and see you later. Bye bye.